Trading Market Technicals morning call video for Wednesday, January 30th. The market continues to show its resilience. Dow up 72, NASDAQ a fraction, S&P up 7. The Dow is now up 16 out of 19 days. Today we have, most importantly, the FOMC rate decision here at 2:15. And we all know that the Fed is committed to monetary easing for an extended period of time. Mr. Bernanke has tied it to unemployment and inflation. I don't expect a change in policy today. But personally, I wouldn't expect a whole lot of new color at today's meeting, although it's worth noting that the Fed has recently gone through a rotation of members, which leaves the members that are there now, a far more dovish side than it has been. There's really only two, which is Bullard and Esther George. Now, the other two, those are the two voting hawkish members. So as I see it, it's probably going to be more to the dovish side. And this is really this market should be pricing in any comments out of the Fed. Now, at the same time, I'd like to say that there is room for a letdown, which comes out would be less dovish in the markets than what they're looking for. So I do see that the Fed policy closely tied to unemployment. Friday's unemployment, the non-farm payrolls, which comes out the first of every month, is going to really be a big influence on price action. So my look at it is that any signs of improvement in unemployment will be interpreted as risk off and dollar bullish, while anything of a bad number, if we get a real bad number, then I think risk on assets will continue to buy, and they will continue to sell the U.S. dollar. And that's really what I'm looking at. Now, obviously, the short term here, we had risk on the whole month of January, part of February. We are overextended, highly overbought on our daily, and now going into our weekly charts. But like I said, overbought and or oversold is not a sell signal. Price is what pays us. Price tells us where the market is headed, and that's how we should be reacting to it. So, therefore, if you are comfortable buying the market as a swing trade, or if you're a long-term investor, obviously, then you should be either tightening your stops and or buying some protection. If you're a swing trader, obviously just tighten your stops. And day trading really is not much. I would be just looking for the best setups. Personally, I am looking for the best setups out there. When there's really low volatility, I'm more of a volatility guy. I like to see price movement with some volume coming in. So I try to look for a catalyst, something to tie it to. Obviously, a good catalyst, not something that's mentioned on CNBC. Anyway, so I like to keep my palates dry and take on the selective trades. Very little trading until the market starts to pick up steam, whether it be to the downside, we get a pullback, and then I would be looking to buy the market. So the forecast right now is very, very difficult, because with the Fed easing now, and we had a POMO, Fed pumped billions of dollars yesterday, and that's one of the reasons why the market is up. And again, the reason why this market we are at new recovery highs is because of the Fed, not because of anything else but the Fed. So please keep that in mind. But again, you cannot fight the Fed. I get calls every day. Oh, I'm looking to buy VIX puts. I'm sorry, looking to buy VIX calls, thinking about an increase in volatility. Well, an instrument like that will just decay your investment if the market just continues to grind higher like it has been. So it's just a losing bet right now, and I would be waiting to see what really happens. Now, usually every month we get that non-farm pay. We definitely get the non-farm payable. Usually we do get some excitement. In the last couple of months on the non-farm payroll really had very little reaction to it. So I think this Friday will be really something that we're going to be waiting on, and that's something that I'm waiting on. Okay, so let's get right into the charts. Really, nothing has changed. So I'm going to run through some of the indicators that we all normally see, and as you can see here, very little change in our NYMO. We're still stuck in this range here that we have been chopping around the whole month of January. Okay. Our tick chart elevated extreme levels here. So is the S&P 500. As you can see, our ratio chart here. Again, just noting how we are. We need price to start breaking down pivotal lows and start making lower lows and lower highs for us to really get involved on the short side. Other than that, I'd be looking for the best setups. Take a look at our S&P above the 50-day moving average, and again, highly elevated, again up 80 cents. So this is, again, a word of caution, just something to keep an eye on. And then I want to talk to you. Well, look, let's take a look at the indicators, and I want to go into bonds real quick. S&P above the 200, again, highly elevated. Okay, now, aside from the Fed pumping in dollars, you see the 10-year, like I mentioned here last week. I said watch the 10-year rising, and again, sure enough, up again yesterday, up 203. And that goes into the bonds, right? Bonds are breaking down. We have a head and shoulders on the bonds here, and downside target's going to be right up in this area. So an additional money flowing into equities is bonds. As yields are rising, bonds are starting to fall apart here. We've been in a 10-year run on bonds, and as yields are rising, money's coming out of bonds and going into risk-correlated assets. So that's another good help. Now, until yields get up into some really something to think about and really exciting, I don't think that's going to be an issue. But still you still want to be looking at what the yields are doing and what bonds are doing as well. Okay, so now take a look at the transportation sector. Extremely overbought from January. From here, the market, obviously the bonds, the transportation sector has been up the whole month of January other than 3 days. And as you can see here, really due for a pullback. We're extremely overbought in RSI. So what we could easily just bull flag right into the 8, which is a momentum average, and then shoot up higher again. So again, shorting the transportation sector, I want to see take out some real good pivotal lows before I get involved shorting anything in this market. All right, now what I want to see is what's unusual is we have safe haven sectors, right? We have the healthcare, we have utilities, and consumer staples. Well, they continue to rise as well as the market, and it just really amazes me how money is also being hidden in these safe haven sectors. And here's healthcare. Here's consumer staples, way elevated, broke out, and continues to rise up. And here are utilities. And let me just get the utility shot here a little bit higher, excuse me. And here we go with the utilities. And as you can see here, we did have that breakdown because of the new tax laws, and then all of a sudden, now we're recovering back to those post-November highs. So here is something that is also another concern of mine. That why is, usually you get the inversely correlative risk on. Usually, people sell safe sectors like these three sectors: the utilities, consumer staples, and healthcare. But they're also rallying with that. Okay, so that's something just to kind of keep an eye on. Here's copper. Copper's starting to tick up a little bit, and again, the weekly chart, we have the longer-term symmetrical triangle, and we're at the apex here. So a breakout in copper will definitely help equities. And everybody's looking for the pullback as well as I am, because me personally, I'm not looking to buy at the mark. That's not part of my trading plan. Way up at these elevated levels, you're going to take one bad day that comes out in the overnight session. S&P will be down 30 handles when you wake up the next day. So just something to keep an eye on. I wouldn't be adding for the people that are swing trading and position trading. I wouldn't be adding at these levels here. And the S&P could easily go to that 1575, and that's what I want to show you here. And this is the SPY, so same chart is exactly the same chart. I think that's where we're looking to go. We're looking to test the 1575 area here, like we did way back from 2000, 2007, and now we're back here we're literally 6-7 points in the SPY breaking to get up above these areas. So I think that's where we're looking at be in the next maybe month or so. I think we can get there quicker if we had a decent little pullback, 2, 3, 4% correction, and then the market would probably rally and then look probably for a sell-off sometime in the spring. Again, a longer-term picture. Okay, spiders, we're basically about 35 cents, 36, 34 cents away from our target. And I got a lot of emails stating, "Oh, you got to be kidding me! You really think it's going to go that high?" It's not me. It's what I'm reading on the charts, and that's what it's telling me, and that's what I go by. So But the thing is, as you can see, we're just grinding higher. If we had some decent volume and some volatility, at least a little bit of volatility, it's a little bit easier to get involved, especially when you had this big gap. And again, gaps eventually get filled, but they don't have to get filled right away. They could take months before the gap gets filled. And that's obviously something that everybody's looking at, is this big gap up here from the 2nd of January, from the 31st. So keep an eye on this. Let's see if we can get our target hit possibly today. S&P E-mini futures are up a couple of handles this morning. Nothing really to write home about, but that's how it starts every day for the last 16 trading days. Although yesterday we were down about 3-4 handles, recovered. And by the way, I might mention pending home sales were up. They had a good number. Consumer confidence had a real bad number. Market totally reversed, chopping around for about an hour and a half, and then just broke out of this area and then just grinded high the rest of the day. So really not good day trading, if you will. All right, S&P Spiders, we had the 60-minute. I said watch for negative divergence in here. Again, negative divergence is being negated. We broke back out of it, so this I'm going to take out again, as I did back up in here. So this is something, every time we have negative divergence or positive divergence against what the market's doing, you have to point it out. If it plays out, it plays out. If it doesn't, then you just move on, and then you look for the next one. So as you can see, indicators lag price. Price is what pays us. So because you have negative divergence, and if price doesn't break these areas, like I pointed out, then there's no reason to do anything. Okay, so that's exactly what I wanted to make a point of. Okay, so now we have 150 would be the break on the S&P, and then 148.20 would still be the break on this bigger trend line here, this longer term trend line from the month of January. So these are the two new lows that I'm looking for on a break and close before I get excited about looking to short the market itself. Okay, and this is the Spider 30-minute chart. As you can see here, we were literally halfway in the month, did really nothing. We were in a channel. We broke out of this channel, tested, and then now we just grinded higher on low volume up until yesterday. Again, head and shoulders pattern, 1507. We had a high 1510, excuse me. So 10 more points. We'll probably get that today. So not a surprise by the FOMC. I like the way the CCI is holding above 100. Every time when there's strength in the move, we usually hold above 100. Like we see, we didn't do that here. So we consolidate it, and then we pop back up, and now we're holding 100. So again, very constructive. The longer term picture is actually looking very, very good for the market. Again, it's not healthy for the market not to pull back, and with the algorithms, they're really, if you really stood by the looking at price action, which I do every day, that's part of my trading plan, you could see literally the algorithms just going totally crazy. And if you look at any of these charts, Amazon that reported yesterday, bad number. They missed their revenues have been decreasing for the last 10 quarters, and the Amazon is still at out of control PEs. They bought the Amazon higher, and they actually was down, and then they ran them up. And it doesn't matter because of the earnings, right? It's what the traders really want to do. If they want to bring this up and it's a cult following, so be it. You can't fight it. And just crazy. If you go look at a lot of these charts, they're up 15, 20%. Some of these smaller cap stocks up 100% in 2 or 3 days, and it's just insane that people follow it and they run up some of these stocks. But again, you can't fight it, and looking to fade something like that is suicidal in this market, especially with the algorithms literally on a buy, just literally buying the market up. Okay, now S&P 30 minutes, same thing, really no change here, guys. We broke back up, and now we're just kind of grinding higher. Bollinger Bands are tightening, so looking for some sort of another bigger move. Diamonds, as you can see here, 16 out of 19 days. If this isn't extended, I don't know what is. But again, reason, look at the transports. Transportation sector taking the market and everything else up with it. So something to keep an eye on. Now, if oil starts to really tick higher, the transportation sector is going to be a cue for the markets to actually start, not the markets, but at least the transportation sector to at least take a break. But again, oil really has to start spiking higher here. And here's the IYT ETF. Again, we have 3 indecision candles, some hanging man in here. So this is something that we're going to watch in the coming days. Maybe we break the low here, 103, and then you can put some sort of a short on. And IWM's reached our target, and then some. We're up at 90 now, grinding high with these little candles. Now what happens is, and what will happen is, by not having a pullback and this zigzag motion as we move higher, like down, up, what happens is it'll take 3 or 4 bad days and you'll wipe out all this whole move. And that's what usually happens. I'm not saying it's going to happen now, but that's what usually happens with this slow grind without having a pullback or rest, and then a breakout, a pullback, a rest, and a breakout, and it's choppy, like in a 3 to 5 way patterns. That's what happens to the markets. And then all of a sudden you have a big down day. Apple, just want to show you weekly, we're getting back to this 470-ish. So far so good. At the end of the week, I'd like to see Apple break above the 470. And then, if for a longer term swing for a recovery bounce, not saying he's going to the highs, for a recovery bounce maybe to the 20-day, back to the 565, 570 area. And again, we do have some resistance up here. As you can see, our volume profiles, we have a thin zone. So if we can break back above, let's call it, well, we're above it now. If we can get back above the 465 area, I think you got a shot to the 505 area. And again, and that's a tradable bounce. That's all that is. Technically, we've had some real technical damage. It's going to take a long time before Apple gets anywhere close to the 600 area. Obviously, unless something is announced. And again, here, just the daily chart here, back to the 460 area. Head and shoulders pattern played out real nicely, worked out. So now we're just looking for some sort of a tradable bottom here. And lastly, the Q's really not doing much of anything. So we're just right in this channel. And we'll see if the Q's start to break out, technology starts heating up again. That'll definitely help the broad market. All right, guys, have a great day today, and we will talk to you tomorrow. Take care.